Hello and welcome to this special broadcast on CNBC Africa of the last Monetary Policy Committee meeting of 2025. The South African Reserve Bank poised to decide on whether to cut rates or to leave them unchanged. Opinion in the market is split. There are people roughly on either side who say it could be cut and it could be a hold. Why? Because obviously inflation has been well contained within the South African environment, and we've also seen lately very positive moves from the government in terms of that budget that was presented just the other day, and showing South Africa's finances in shape. The governors on the podium. We're going to Pretoria.
Shifting, but global growth is holding up better than expected. In the euro area, inflation appears contained. However, in other major economies, price dynamics are more challenging, with deflation risk in China and inflation materially above the 2% target in the United Kingdom, Japan, and the United States. In emerging markets, by contrast, inflation has eased. Indeed, 2025 has been better than expected for emerging markets. This is due to stronger capital flows and a weaker dollar, as well as favorable terms of trade. Meanwhile, there is an investment boom underway in artificial intelligence infrastructure, accompanied by aggressive valuations for major technology stocks. Despite the promise of AI, there are signs of a bubble inflating. With lower rates and cheap credit, even for riskier borrowers, financial markets appear vulnerable to a correction. If that happens, emerging markets could suffer from spillovers. Turning to South Africa, growth is looking steadier than last year. The outcome of the second quarter surprised on the upside, and the third quarter indicators are looking broadly positive. Our 2025 growth forecast has therefore been revised slightly higher to 1.3%. We continue to see growth nearing 2% over the forecast horizon. Employment has also been rising. Household spending has been relatively strong to date, supported by wealth effects, further withdrawals from two-pot pension savings, and lower inflation and interest rates. At the same time, investment has disappointed, falling further in the first half of the year. We expect an investment recovery in the second half. If this materializes, it will be an encouraging signal that the economy is getting back to its historic growth trend. As it stands, growth is better, but not yet healthy. The risks to the growth outlook are assessed as balanced. Moving to prices, inflation has accelerated somewhat over the past few months, reaching 3.6% for October. This is higher than the 3% average for the first half of the year. The uptick is due to non-core items, mainly meat, vegetables, and fuel. We continue to see this pressure as temporary, with inflation heading lower again from the beginning of next year. Indeed, recent outcomes have undershot our forecasts slightly. Because of these downside surprises, together with a stronger rand and a lower oil price assumption, we have small downward revisions to our inflation outlook for both 2025 and 2026. We remain on track to deliver 3% inflation over the medium term. For inflation expectations, we do not have an update from our usual survey at this meeting. But market rates and surveys of analysts both show further progress towards the 3% objective. Core goods prices are benefiting from exchange rate strength. Food price inflation seems to have peaked, although we have a small upward revision to this forecast, mainly from beef prices. Services inflation is unchanged from the last meeting. The announced medical aid increases are lower than last year's. At the same time, housing inflation has accelerated, which warrants ongoing scrutiny. We assess the risks to the inflation outlook as balanced. Against this backdrop, the MPC decided to reduce the policy rate by 25 basis points to 6.75% with effect from the 20th of November. The decision was unanimous. Members agreed there was scope now to make the policy stance less restrictive in the context of an improved inflation outlook. The quarterly projection model continues to forecast gradual rate cuts as inflation subsides. As before, this rate path remains a broad policy guide. Our decisions will continue to be taken on a meeting-by-meeting basis with careful attention to the outlook, data outcomes, and the balance of risks to the forecast. For this meeting, we considered two risk scenarios. The first scenario featured a US dollar rebound, recognizing that while the rand has appreciated this year, this partly reflects broad dollar weakness, not just rand strength. In this scenario, the rand depreciates back to its 2023 levels against the dollar, rather than holding on to its recent gains as in our baseline. The second scenario was based on higher administered prices, linked to a rapid correction of the 54 billion rand electricity price error disclosed a few months back. The scenario also had inflation expectations staying higher for longer in response. Both scenarios featured tighter monetary policy with rates coming down more slowly compared to the baseline. The administered price scenario in particular shows that if price setters take on board the 3% target, we will have space to get to lower rates faster. This brings us to the subject of the new target. As announced last week, we have moved away from the 3 to 6% target range, which was established 25 years ago. The revised target agreed between the Minister of Finance and myself as the Governor of the South African Reserve Bank is 3% plus or minus 1 percentage point. As we move from a range target to a point target with a tolerance band, it is important to understand that what the new target means. The tolerance band of 1 percentage point on either side of 3% does not mean we will be indifferent to inflation anywhere between 2% and 4%. We want to be at 3%. However, no central bank has the tools to deliver inflation at an exact point all the time. As flexible inflation targeters, we also recognize that trying to offset all price shocks would create undesirable volatility in output. To support communication and accountability, we therefore want it understood that inflation will not always be precisely 3%. When there are deviations, we will explain what has driven inflation away from target, and we will do what is required to get back to target. Most of the time, we should be expected to keep inflation within the tolerance band. with breaches occurring only when there are severe shocks. We will always be setting policy so that inflation reverts to 3%. Monetary policy actions have their main effects on prices after 12 to 24 months. So you should expect us to achieve our target over that horizon. Accordingly, we want longer run expectations to anchor at 3%, staying there even when there are shocks. This lag between monetary policy decisions and outcomes also explains why the 3% target is taking effect now, but will be achieved over the forecast horizon. The MPC has long emphasized the need for macroeconomic and structural reforms to boost potential growth, to achieve a sustainable debt path, and achieve a low inflation regime. There has been significant progress on reform this year, as underscored by the recent credit rating upgrade from Standard & Poor's, as well as South Africa's exit from the Financial Action Task Force, FATF, grey list. The global environment, nonetheless, remains challenging, so it is urgent to sustain domestic reforms efforts. That concludes our statement, and I will take questions. And as usual, I will distribute the questions depending on the complexity of the question. Right at the end there.
Good afternoon, Governor and the panel. My name is Ntando Tukwana from Bloomberg News. Governor, you've always maintained that looseness on the fiscal side makes the work of monetary policy authorities difficult, and that you have to compensate for their failings. And I'm just wondering what your thoughts are now, given the improvements we've seen fiscally as announced in the budgets last week. Thanks very much.
Did you say your name?
Ntando.
Ntando. Kopan.
Good afternoon, Kopan Ogumbi from Reuters. Why does policy still need to be restrictive? And then we wonder if a 50 basis point cut came up, and if not, why? Would it have been considered an aggressive course of action, or would it have been too soon since the new inflation target was announced? Thank you.
Those are the only two interested. Okay. Ntando, if you are in a position where monetary policy has to compensate for fiscal savings, you are now into an era of what is called fiscal dominance. So instead of the monetary authority focusing on its mandate, it compensates for the failures of fiscal policy. When that happens, you end up with higher inflation, which is going to require more aggressive monetary policy response, and the economy is none the better, because what you are going to have is that could come at the cost of output. I think that the response from the market seems to have been that they had viewed the fiscal stance positively. As has been reported, we would now have seen 3 consecutive years of primary surpluses, which means that the Treasury will be able to arrest the debt. Importantly, is that in the past while, what you have heard was the Treasury was talking about debt peaking in the third year of the MTEF. In this budget, they said debt will peak in the current year of MTEF. So that counts for something, and we hope that that gets achieved. Kopano, there was no 50 basis point proposed by any member of the MPC. If you were to, for now, forget that the quarterly projection model is a policy guide and you are just following it and accept it as the 7th member of the MPC, the QPM had said is 25 basis points at a couple of meetings going forward, and it had like 5 points of 25 basis points. Why should the fiscal monetary policy remain restrictive? Well, we are in a very uncertain environment, and it's important that we move with caution. And as we have stated, that any future decisions will be taken based on the outlook, the incoming data, and our assessment of what that means. And that is what will form the basis of future decisions. If you look at the quarterly projection model, it basically says to you that you will get to something like 5.75 in the outer years of the forecast horizon, and it doesn't say that you must do it now. Alistair.
Alistair Ball from Bloomberg. Thanks very much for taking our questions. You mentioned the S&P upgrade, and they also kept South Africa with a positive outlook. What, in your opinion, will it take for the rating to be upgraded again, and for South Africa to restore an investment grade rating? Thank you.
Hi, Alex Winning from Reuters. Did the central bank buy foreign currency for its reserves in October? And if so, how much, and what was the reason for buying those reserves? Thank you.
Is that it? Anybody online? Everybody said the G20. Okay. Alistair, I actually think that it's much easier forecasting inflation rate. It might even, complex as it is, it might even be easier forecasting exchange rate than forecasting what rating agencies are going to do. And part of it has to do with the fact that whereas in our case we publish our quarterly projection model, and any analyst can take that model, they can play around with it, change the assumptions, and challenge us and tell us your forecasts are wrong. The rating agencies tell us their models are proprietary. So it's difficult to take their models and interrogate them and say, where is this thing going? What we do know, though, is that once there is a positive outlook, it tells you that the rating might change in the direction of the positive outlook in 12 to 18 months. A reading of the S&P statement spells out the factors that would lead to an upgrade and the factors that would lead to an upgrade not taking place. And all that then that South Africa has to do is to look at those and say, where are we on course to meet these things? And in a way, what people seem to miss is that what South Africa has had is actually a double upgrade from Standard & Poor's. Because what normally happens is that if you are on a positive outlook, you will get an upgrade, and then you will be put on a stable outlook. And only after a while will the outlook be revised to positive before you are upgraded. South Africa got upgraded and maintained the positive outlook, which then says to us that the momentum is a positive one. But then this brings us back to what I had said in the past. Our credit rating is within our control. Our ability and our willingness to service our debt is within our control. And if we address those issues, an upgrade would become imminent. I looked at the previous downgrades from 2017, and what the rating agencies said was going to happen to our debt. Some of them even had figures of the debt will be 94% of GDP by fiscal 2024. That was, they are saying that in 2017. We are actually at only 77% and peaked. And if the MTBPS figures hold, we will then be on a declining trend. And part of it could be that it is a correction of the stance that the rating agencies took and went too far in the other direction than they were supposed to be. But that is an engagement that we should have as a country. As I said, it is within our control. Alex, the figures were released. I'm sure DG Kasim has them. What were the reasons for buying the reserves? If there is a sale going on, we take advantage of it. So if there was cheap foreign exchange in the market, we will take advantage of it and put it in our kitty. When we buy Forex, we do not buy Forex because we are targeting a particular level of the exchange rate. Actually, all of those reserves were acquired at different levels of the exchange rate. Our policy remains that our approach to the foreign exchange market is that we have got a floating exchange rate that enables us to absorb shocks. DG Kasim, do you have the figures for October?
Just to say that it's very hard to work out, but I would say that it's kind of a few $100 million, and it's basically when we do this, we're very conscious of doing it in small increments, not to affect the exchange rate. It is also important to distinguish that it's not a, it's really, as the governor said, small incremental amounts, depending on what's going on in the exchange rate market. If there's an FDI inflow into the country, the rand is strengthened slightly. So it's really in that context that you should see it. Obviously, once the next couple of income statement comes out, you'll get a proper figure. Thanks.
Sarah?
Yes, we have a question from Artwad Lamini from Alliance News. He asks for you to briefly sum up the year of 2025, namely what are the key factors that have influenced your deliberations during the year?
Is that the only question?
That's the only one online.
Okay. Any other question from the room? Ntando?
Governor, just another question on your earlier comments about the AI bubble, which you said is inflating. Just how badly do you think that South Africa will be impacted once the bubble bursts, and when do you think that will be?
By very nature, bubbles can't be predicted. You just know that it will happen at some point. And, there was a governor who visited South Africa, and he wanted to go to the game reserve. And he said, "Can you please describe an elephant to me?" And we told him, when an elephant approaches, you will know it is an elephant. And a bubble is almost like that. When it comes, you can see that it is coming. Dlamini, how do we round up 2025? I will round up 2025 in one word. It was a very uncertain year. That is it. I can't offer any further than that. I see no further hands. In the light of there being no further questions, I can only wish you happy holidays wherever you will be, and there are some chaps that we are seeing next week. We hope to see them. We hope to see them there. But thank you very much for your attendance. We will see you next year. There are dates of the MPC. The January MPC is the 29th of January, and there are dates for the rest of the year. So please don't ask for any interviews or bring any media queries within the blackout period, which happens just before the MPC.